It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is Esther Gulius, the tax lady, and we're talking taxes, and it's tax season, and our job is to make sure you don't overpay, and we want to help you. So if you have any questions, you can join us here in studio, 803-0930, 803-0930, star 930 on a cell phone, and I have my sidekick here, Tiffany.
Hey,
Tiff.
I was just saying I was so glad that it's March 5th because the big bulk of tax season is nearing an end.
That's true. That's true.
It's a lot of work.
And for those of you that are watching on TV, WBBZ, it would be 1 week later because we're doing this show on Saturday from 3 to 4 on WBEN. And for those of you listening in Florida, on WGUF, we welcome you too, and I'm Esther Gulius, the tax lady from EG Tax. We have all of our offices are open 9 to 9 Monday through Friday, 9 to 5 on Saturday, and there's really no situation that we can't help you with. Our fees are at least 50% of the national competition, and we do a good job, and we really do care.
It was so cute. I had a call the other week. It was from a client, and she's like, "Oh my God, I'm so excited! You're in Newfane." She lives in Newfane. She goes, "I had been waiting for you guys to come to Newfane," and so she made her appointment for her whole family. Yeah, yes.
All right, let's. We want to talk before we get to the phones. We have phone calls. We want to talk about little things you need to watch out for. Okay, first thing is, you know that line on the tax return that says state refunds?
Yep.
It isn't always taxable, is it?
Correct.
Your
No.
refund from the previous year is only taxable if you got a tax benefit for using it as an itemized deduction.
Correct.
So number one, if you didn't itemize, you don't put it on.
Right.
All right. Also, on New York State, there are all kinds of refundable credits. There's a refundable earned income credit. There's the refundable child tax credit. There's the refundable Empire State Child credit. So if you have a refund of $500, but you got credits of $700, you also don't put that refund on your tax return.
And another...
So putting $1,000 in refunds that you shouldn't have done in the 25% bracket just costs you $250.
Yep. And another really, really important thing is just whatever refund you see on New York State is not what, if you have to report it, is not what you report. You should minus off all those refundable credits on New York State.
What I said.
Okay, well, I reiterated your point. Yes.
Thank you for
You're so welcome.
reiterating. Okay, so other things you got to watch out for is making your Social Security more taxable.
Yeah.
Remember, your Social Security can be taxable if you're somebody getting Social Security if half of your Social Security added to your other income and you're married filing a joint return exceeds $32,000. Half of your Social Security added to your other income if you're single at $25,000.
Right.
So you want to make sure that if you can control your income, if you can spread that income out over 2 years rather than lumping it in another year, you make your Social Security less taxable.
Yep. There's so many times people have a big project and they want to take money out. We say spread it out over 2 years.
That's right.
And it'll
so
be a better impact.
December 31st you take it, January the 1st you take it.
Right.
Okay, we're going to give you more tips about this stuff. I'm Esther Gulius, the tax lady from EG Tax. Join us here in studio, 803-0930, 803-0930, star 930 on a cell phone, and we're going to go to Harry. Hey, Harry, how can we help you?
Good afternoon. Thank you for taking my call.
Yeah, what can we help you with?
I have a question regarding taking the premium health insurance tax credit.
Okay.
Specifically, Form 8962.
Okay.
Okay. And I bought health insurance through the New York State Marketplace, which began in March. I was eligible for it till November when I went on Medicare. I took retirement, and I lost my health insurance at work. I bought it on the Marketplace.
I gotcha.
I overestimated my income for 2014.
Okay, so that means you didn't get any kind of subsidy.
Well,
or you got too little of a subsidy.
Well, now wait a minute. I didn't take the monthly premium
subsidy,
monthly advanced payment of
the
premium
subsidy.
Tax credit.
Right.
I did not take it.
Okay.
I paid the full.
Gotcha.
Full amount each month.
Righto. Gotcha.
Because I was afraid to get to the end of the year.
Yes.
Okay. Now everything's good. I've got the health insurance marketplace statement, 1095A.
Yep.
That's all perfect. Just
I gotcha.
like it should be.
Gotcha.
But here's my question. Because New York State has expanded Medicaid,
would you qualify?
or probably I should have been on that at some point during.
Okay, but all right. Here's the thing, Harry. You need to fill out the form, the computation on the form, and it's going to show you how much subsidy you were entitled to. And if you didn't get that subsidy, that's going to be a refundable credit, which is the premium tax credit. And so you just work through your form, and it'll all work out. And they're actually going to give you money back if you were entitled to the subsidy.
Okay. Now here's what I'm concerned about. My item on line 5 of 8962 comes out to be 125% of the federal poverty level. And that makes me eligible. The federal guidelines are you have to be just above the poverty level, up to
100 to 400%. Right. Okay.
But
I'm going to tell you, Harry, I can't do the thing over the radio.
I'm almost thinking.
So this is what I'm going to tell you to do. If you want to call our office at 632-7886, one of my preparers will be there, and they can help and explain how to do it. But the bottom line is you qualify for the premium tax credit, and I can't do it over the radio.
And then also Tim Eliason is a healthcare navigator. He can help too.
Yeah, I'm waiting for the ask. Okay.
Because New York State, there was I think at 134% or 138%. Will the federal government pick up that I'm in New York State?
The federal government will pick up that you're in New York State, and they're going to use the lowest cost silver plan as the basis, and
that's okay. But what I was afraid of is they'd say I was disallowed.
No, you'll be fine, Harry.
But
if you want help, you can call us at 632-7886, and somebody will walk through it with you. Okay?
Okay, but you think it'll be all right?
I know it'll be all right.
Okay. Well, thank you very
Harry.
much for your help.
Thank you, sir. Here's the thing. I mean, you send it in, and they're going to double check it, and if there's any adjustment, they'll adjust it back. But that's probably the biggest problem that we're having this year is when people come in and they got their health insurance through the marketplace with a subsidy.
Correct.
Because then you have to reconcile the subsidy that you took with what you were actually entitled to for. And if you got too little subsidy, they give you a refund. If you got too much subsidy, you pay it back.
Right.
And it ends up being a mathematical thing, and I don't have my calculator and stuff.
It's a new situation, and so we're all learning.
Well, I'm Esther Gullius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. For those of you listening in Florida, don't call us, and you get us at 4 o'clock. You have to call us at 3.
Right.
And if you're watching on WBBZ, I'm Esther Gullius, the tax lady. We're going to take a short break. We'll be on the other side.
Yes, I know that I'll never work out exactly how you think.
I told Tyler, let it go. I'm Esther Gullius, the tax lady from EG Tax, and we want to help you with your taxes. And if you're listening on BBC, this is a recorded session of our radio show on WBEN on 3 to 4 on Saturdays. So if you'd like to be on, call us on Saturday. And for those of you listening, we want to help you with your tax questions. We kind of have a subject here today about little things that you need to watch out for. We were talking about making Social Security more taxable.
Right.
Watch it when you gamble.
That will do a number on your Social Security.
You know, because you can be somebody that doesn't have taxable Social Security, and you pick up $3,000 or $4,000 or $5,000 in gambling winnings, which have to be listed on line 21, and the losses are on Schedule A, and you end up making your Social Security more taxable.
But so many people think, oh, well, if I have losses, it'll just offset it. But it doesn't. They live in two different worlds.
That's exactly right. Another thing you should watch out for is taking too little money out of your IRA.
Right.
Because you actually don't pay taxes if you're a senior and you're married filing a joint return until your income exceeds $23,100. So if you're somebody that has a pension of $5,000 and some Social Security that isn't taxable, you can actually go and take money out of your IRA and you won't pay taxes on it at all.
Right.
You know, people are waiting for their RMD. You don't have to wait for the RMD. You can take it out ahead of time, put it in the bank, and you don't pay tax.
And that's that same reason why some people are putting monies into Roth IRAs, and I say, but you might never pay taxes on it, so why are you paying the taxes
This
up front?
morning I had somebody that said that they were putting money in a Roth.
Right.
And I said, so, and you don't want to say to somebody, I know you're not going to have much money when you retire.
Right.
But many people that are listening are not going to have much money in their account when they retire. And so they thought that maybe they'd end up with $100,000, $200,000 in their IRA. And I said, so if you annuitize it, you're going to take out maybe $2,000 or $3,000 a year plus your Social Security. There's no way that IRA would ever been taxable. So here now, when you're younger, you're shooting yourself in the foot. And when you retire, there's no benefit. You want to be careful that you take out as much as possible and don't use a Roth if you shouldn't use it. And if you guess at it, you're going to get the wrong answer.
And sometimes a broker will say, but it grows tax-free, but you really got to look at the big
that
picture.
growth that we're getting, that 1% or minus 3%. But even with the growth, it's still not going to pay taxes. Right. Okay, I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone, and we're going to go to Gordy. Hey, Gordy.
Oh, yeah.
I love your name.
Oh, thanks.
That's a cool name. You know, when you got a name like Esther, there's like no way.
Got
like
name
you're
envy.
Obviously Gordon, right?
Yeah.
See, Gordon,
thank you.
what can you do with Esther?
Esty?
Esther.
Esty?
Esty. Yeah,
Esty.
Esty. I can't even tell you what kids used to call me. But anyway, all right, yeah, Gordy, what can I help you with?
Oh, just a small item here regarding long-term capital gains.
Yep.
Gains. On line 13 on the 1040. It says capital gain or loss, and then put the amount. So I got a 1099 for like $7,800 for capital gains. But my question is, if I'm in the 10% bracket, I'm not supposed to pay any tax on my capital gains, right?
Okay, so here's the thing. The computation for the tax liability is not using, you're not going to put that capital gain into the regular tax liability. The computation is done on the Schedule D. So you have to go to the Schedule D to compute the taxes, and so that's where it's going to say how much did you get in capital gains, what's your tax bracket, and that part they're going to peel off and make it at 0% because that's what you're going to qualify for, and the rest of your income is going to be taxed at the regular tax rate.
Yeah.
You can't do it any other way, Gordy, and if you don't, you said there was how much money? How much did you say?
Capital gains?
Yeah, how much did you say?
$7,800.
All right, so you're going to overpay by about $800 if you do it any other way. So you got to use the Schedule D.
And I might be reiterating again what Esther said, but don't forget on page 2 that when you figure out your tax bill, you use the Schedule D worksheet too.
Right, that's what I said.
Yeah, I know.
So what do I put
said
down
I'm
on line
reiterating.
13?
Pardon me?
What do I put down on line 13?
You're going to put the amount on line 13.
After the
But
computation.
the computation is done on the Schedule D worksheet.
So it's included in my income then. That's $7,000.
Well, it is, but it isn't. See, so all the way to page 2 of the 1040, it's in there. But then it says taxes, right? And then it says computation, tax tables, tax rate schedules. Then there's something that says Schedule D. The Schedule D is where the taxes are coming from.
Okay.
Okay?
Yes.
All right, Gordy.
Thank you.
Like your name. Bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone.
If you're texting, you would do 30930.
That's right, if you want to text us your question.
Right.
And we're going to go back to Mike in Hamburg. Hey, Mike, how can we help you?
Hello, Esther.
Hi.
Got a couple questions. My wife and I decided to get into a brokerage account from a local bank last year.
Okay.
And we got a 1099 DIV in the mail and a 1099B.
Mm-hmm.
Now the 1099 DIV has got the the qualified dividends, the ordinary dividends, and something called capital gain distribution.
Right.
And also it's got something called foreign tax paid.
Right.
On it. So, well.
All right. So let me tell you how each one of those things. When you look at that 1099 DIV, it's like looking at a plate of food. You got the hamburger, the French fries, the salad. It's all different things. So the dividends are handled as on the Schedule B at the bottom part, with qualified dividends being taxed on the Schedule D, just like Tiffany was talking about. You're going to use the Schedule D worksheet for the qualified dividends. The capital gains distributions also go to the Schedule D worksheet. The foreign taxes paid go to 1116, and you get a foreign tax credit for the taxes paid that your mutual fund was involved in.
And then he talked about capital gains. He talked about capital gains, or did you say
on the Schedule D? Yeah.
Now, do I have to put all this stuff down on there? Because the last statement that we got from this brokerage account last year, we lost like $4,000.
Okay, so here's the thing. This is what the IRS has. And they're going to be looking for your dividends. They're going to look for your qualified dividends. They're going to look for the sale of the stock. They're going to look for the capital gains. If you don't put it on, guaranteed you will get a bill in the summer.
And then I think you'll have $1,000 loss carry forward. It sounds like if you had a $4,000 loss from the year before, you used up $3,000, you'll have $1,000 to use this year,
which will reduce your other income. So here's the thing, Mike. Maybe you're somebody that doesn't like to use a tax professional, but I'm going to tell you, and I'm not telling you to use EG Tax, go to somebody who knows what they're doing, because you are shooting yourself in el footo. You go anywhere, Mike. Just go to somebody that's reputable, but you should not be doing this. It just ends up costing you money.
And then another thing that I really want to say, Mike, I've been doing this for a long time. Keep track of your basis. You know, all those capital gains and all those dividends. When you go to sell this stock, that all increases your basis. So your basis is more, so your gain will be less. So you have to keep track of this.
Of course, the broker, if it's a recent thing, they're keeping track of it for you. But the thing is, it's really... when you have capital assets and sales of capital assets, there's a different computation. Just like the gentleman before that called, it's just if you're not using a tax program, you should use a tax program at least, or go see a tax professional.
Okay.
Okay, Mike.
Now, what is exactly a capital loss? Is that only when you sell a stock, or?
That's right. When you sell, if you paid $3,000 for the stock, sold it for $5,000, you have a $2,000 loss.
Okay,
and so
but you can't claim it.
No, you can claim it.
You can't claim it until you sell it.
Until you sell it, right.
Now,
or it becomes worthless.
Okay. Now, I mentioned, the foreign tax paid that's on the 1099 DIV.
Right.
Does that mean that I have a foreign tax account?
No, it means that your mutual fund that your broker has you in is invested in foreign countries. And so the foreign country makes the stock pay taxes. You get a little percentage of the total amount of the mutual fund, and that foreign tax is done on an 1116, and that's going to, if the taxes paid were $20, you save $20 if you do the 1116. If you don't do the 1116, you won't save $20. Okay?
All right.
All right, Mike, I'm sorry to depress you.
So I got to include that dividends in my income.
Yes.
I would, if you don't want a love letter from the IRS.
Yes, you have to.
Okay, even though I lost last year on the...
Yeah, and the truth is, I bet you last year was wrong, too.
I'm sorry, what?
I bet you last year you did it wrong, too.
Oh, I didn't have it last year. This is the first time we got it.
Okay, but you said that you lost money last year.
$4,000.
Well, yeah.
But you didn't claim it, did you?
Last year.
But maybe he means
you mean on 2015?
No, for 14.
All right,
you
put that?
15.
15. All right, so that's what we're doing, is 15. Yeah, so the loss that you get is going to reduce the other income on your tax return up to $3,000. So that $1,000 loss is going to reduce your other income.
Okay.
Okay?
Okay.
Thanks, Mike.
Thank you.
Bye-bye. Sometimes,
I liked how you said hamburgers, French fries,
they're all
salad.
different. They're all on the same plate.
Right.
But really, those French fries are not the hamburger.
Right.
And the salad is not the French fries. Right. I mean, they're all handled differently.
And then there's some foreign tax credit that's a side.
It's like the side dish. Right. I'm Esther Gilius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on the cell phone. We'd love to hear what you have to say. Ask us the questions. We want to help you, and we're going to Janice. Hey, Jan, how can we help you?
Hi, I had a question about miscellaneous income.
Sure.
Okay. Other years, we had 1099 miscellaneous come in because we had gotten $6 or more from a Google account.
Okay.
This year we didn't get that much, so we didn't get a 1099. I did look at the publication 525. It says if it's under 600, you don't get one. Mm-hmm. Do we still have to claim that money that came in?
What do you say, Jeff?
Oh, yep, you do. You do.
Okay.
You do. Good question, but yes, the answer is yes.
Are there any expenses that you have for making that money, Janice?
I don't believe so, no.
Nothing.
So you have a Google account. Do you use your internet at home for it?
Yeah.
So if you have anything extra, like for instance, if you print reports, if you have the internet because of the Google account,
percentage,
and you use it a percentage, you can allocate back the internet, the paper that you use, printing
Do you
supplies,
ship anything
shipping,
for Google?
yeah, any advertising, maybe you have a website. All those would reduce the amount of money that you got from Google.
Cause a potential loss even, So it's you do have to claim it though. Whatever, even though they don't send you one, you do have to claim the money.
Yep.
Okay, that's what the main question was there.
Yep.
But I understand everything else then too.
Okay, Jan.
Okay, we should be all set. Thank you.
All right, thank you, ma'am. Bye-bye. Uh-huh. I'm Esther Gilius, the tax lady from EG Tax. If you have questions during the week, you don't have to wait for the show here. You can call us. You can call us at 632-7886, or you can join us on our website at egtax.com, and I answer all your questions whenever. So, and the other thing, Tyler, I wondered, when is the news break today?
Oh, we can do it at 30 if you'd like.
All right, that's good. Then that's what we're going to do. I'm Esther Gilius, the tax lady. We're going to take a short break. See you on the other side. I like that song. What? Okay, so tell me, who did it? I like that song.
That is Oasis.
Oasis. Now, are these local bands?
No, Oasis is from Liverpool.
Liverpool, and they're like have hits and stuff.
Oh yeah, they were super popular in the 90s.
Oh, see, I need something like the 20s.
I'll see what I can do.
I'm Esther Gilius, the tax lady from EG Tax, 803-0930. 803-0930, star 930 on the cell phone. And for those of you that are joining us on WBBZ, this is kind of a rebroadcast of our radio show on WBEN from 3 to 4 on Saturdays. So if you'd like to be on the show, give us a call on WBEN on Saturdays from 3 to 4. And for those of you listening, we want you to be part of the show.
Because Esther lets me out of the office a little bit.
Right.
During
we're going back. We're going back.
I know.
803-0930, 803-0930, star 930 on your cell phone. Talking about little things that you should watch. And number 3 on my list was not using the Schedule D to compute your capital gains.
Right. And I think Gordy hit on that and Mike hit on that.
Right.
Yes.
And it's not. It isn't fun. It's very complicated.
Yeah.
But it's you have to understand, if you're in the 15% bracket or less and you have capital gains and you don't use the Schedule D to compute it, you're going to pay too much in taxes. Plain and simple, flat. It was interesting. We were just talking during the break about how that one gentleman sounded like he's going to overpay by about $500. That's like 5 years tax preparation fees.
Yep.
And it would be done right, and you wouldn't have to worry about it.
Nothing excites
because
me
otherwise it's not right.
Yeah, one of my favorite sayings that you say is, "Don't shoot yourself in the foot."
Right.
Yes.
All right. And other things is not listing your medical insurance as an adjustment if you have self-employment income.
Right.
So if you're self-employed and you're paying your own medical insurance, that's an adjustment. So you don't have to have it limited by 10% of your adjusted gross income. It's an adjustment on page 1. That saves you money.
It does. And then sometimes I see people who take it as an expense on the Schedule C, and you're not entitled to that.
Not an expense. And if you're paying Medicare, if you have Medicare Part B and you're self-employed, that you can take it as an adjustment rather than putting it up on Schedule A.
I didn't know that.
So son of a gun. So that saves you money.
That's cool.
If you're self-employed again. Not using your IRA to the best advantage. If you're somebody that's working, and let's say you're a senior, you're 62, 63 years old, still working, you can still make a contribution to your IRA. If you've got a little part-time job and you're all done with your tax return and you say, gee, honey, we're not making any money off of our investments. But if you take your money up to $6,500 if you earned it and put it in an IRA, you'll end up getting a 35% return on investment.
Right.
And so you just move it from this shelf in the bank to this shelf in the bank. And you make that money.
Yep. Before we left the office, I was just telling a client about that, and she's like, And then she also qualified for the retirement savers credit, which is
and so there's all these little angles that when you're doing your tax return, you have to think about because you can create a better or a worse situation.
Absolutely.
All right, let's go back to the phones, and we're going to go to Mike. Hey, Mike, how can we help you?
Hi.
Hi.
I have 2 retirements.
Okay.
My wife's and mine. I filed jointly.
Okay.
You can deduct up to $20,000 of retirement money.
It would be the pension of both of you up to $20,000 a piece.
A piece.
A piece. So if her pension were 8 and your pension's 15, you can take 15 and 8 as an adjustment on New York State.
Okay, it's actually going to be 20 and 20.
Attaboy.
Yay.
But she's not 59 and a half yet.
Oh, well then you can't do it unless she's retired on a public pension like state, federal, or municipal.
Okay. Yeah, that didn't happen.
Okay.
But she's only got another couple of months before she's 59 and a half, which would then allow me to do what you just said.
Next year.
20 apiece.
Right.
But my next question would have been, if that weren't a piece, would you have gone to filing separately? But you don't have to. It's 20 apiece.
It's 20 apiece.
Very good.
Okay, Mike.
Thank you.
Thanks for calling. I'm Esther Gilius, the tax lady from EG Tax. If you need the best tax help for reasonable fees, EG Tax is the place you want to go. Our offices are open 9 to 9 Monday through Friday, 9 to 5 on Saturday. The web is always open. And if you want to do your taxes in your pajamas, we also have that service available through our internet.
Yep. And you can also make your appointment online, which is really great.
And let's go back to the phones. And we got Christy. Hey, Christy, how can we help you?
Hi. My name is Christy Adamzak, and I work at a nursery, and I get a tax W-2 form for the retail part of the nursery, and then I also get a W-2 for the farm part of the nursery, and I was wondering if there's any consequences because of the farm.
No, there's no they're filing 2 different returns. They're doing a Schedule F for the farm and a Schedule C or corporate return for the retail part. And so what they're doing is they're paying you out of 2 different pots. And so they must have 2 different means of accounting. But you put both of them on your tax return now.
Okay, and so there's nothing due to income from a farm that I have to deal with?
No.
And they're W-2s. No. One of them is not a 1099, right?
No, they're both W-2s.
Now, you're good. You're good, Christy.
Good question, though.
Okay, dear?
Great. Thank you.
Thank you. I'm Esther Gilius, the tax lady from EG Tax. We're going to be signing off right now from our family from WBBZ. And until next week, I'm Esther Gilius, the tax lady. We'll see you. And the rest of you, just hang on. We're going to take a short break. We'll be back with your questions. 8030930, star 930 on his cell phone. We're going to take a short break. I'll see you on the other side. I can do this one. How lucky can one man get?
How lucky can one guy
get? Yes.
I kissed her and she kissed me.
Oh, Tyler, you can sing, too.
Ain't that a kick in the head? I know that one. See, all these newfangled songs I can't be doing, but all the oldies, that's way before my time, but I just love those
You
old
remember
songs.
when your
I love those
dad.
songs, yeah. I love the songs that say something.
Yep.
Anyway, but I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on his cell phone. And we're back with our listeners on WBEN, and we'd love to hear what you have to say. And we're going to go to the phones and talk to Linda, who's been holding. Hey, Linda, how can we help you?
Hi, Esther. I'll try to ask this as succinctly as possible.
Okay, but you can be unsuccinct. It's okay.
Okay. About 8 years ago, I stopped working because of a chronic illness. However, I never filed for disability because I really was hoping to get back to work. That never worked, so last year I filed for disability. It was approved within a month, and I got a one-time check for about $50,000, and now I'm getting monthly payments.
From Social Security, right?
Yes. And however, my husband, his annual income is about $75,000.
Mm-hmm.
So for the past 8 years, it was only $75,000.
Mm-hmm.
With regard to filing a FAFSA, our son is a junior right now, and you probably know that the rules with regard to filing FAFSAs are changing so that the students who are now juniors this year will have to file their applications for college during the summer, and then the FAFSA has to be filed in October. So the income that they're going to look at with regard to us will be last year's income.
Okay, and that includes the $50,000. But you can make an election, because in that $50,000 is multiple years payments, is it not?
Correct.
Okay, so you can do. Wait, listen, Linda.
Okay.
You can do something that's called a lump sum election, and on the lump sum election, what you basically do is you recompute the Social Security as if it had been received in those base years, but I have to tell you, with 75 is still going to be.
I know. I was wondering if her husband made less money
taxable.
the other years.
Yeah, no.
Did
your husband always make that much money?
No, it varied from probably 60 to 75 within the past 8 years.
So it's still going to be 85% taxable.
Yeah.
So that's not going to help. It'll be 85% taxable on the 50.
Okay, but my question is, with regard to reporting our income for the FAFSA, they're going to think that, we make the 75 plus another 50 yearly. You see what I'm saying? So
I understand, but unfortunately, there's nothing you can do. What you can talk to the financial aid office and make an explanation.
But all of that 50 won't be taxable. Only
but she's thinking that on her FAFSA form, it's going to look like they make $120,000 a year, and that is not the case. So
Correct.
you have to put it on, because they asked specifically for you to put it on. The only thing that I could tell you is to tell the university that you have a unique situation. You got 1 year with multiple years Social Security.
Because I'm thinking, Linda, your son, who's a junior, right, still goes to the same college, right?
Well, no, he's a junior in high school.
Okay.
Yeah.
Do you know where he's going to go to school?
No,
college?
I don't.
Yeah, because every college, every university has a financial aid office, and so wherever he's thinking of going to school, I would call that financial aid office at that university or that college and explain the situation and see. They're wonderful, the financial aid office at each university and college, and so wherever he's thinking of going, before you do the FAFSA, I would make a phone call to their financial aid office.
Okay.
Yeah.
But I was thinking, is there no way of amending our last 2 years' income tax returns, because the $50,000 is basically.
Oh yeah, you can. Like I said, you can do the lump sum election, which would make it. You still have to pay the taxes on this year, though. So and you can't amend those returns and put it on, because you didn't receive it those years. So you really can't amend those tax returns.
Okay.
It was all payable this year. So it was just a terrible thing. It's a blessing that you got it.
Of course.
But I just think you're going to have to jump through some extra hoops. And the good thing is, next year when you do your FAFSA, it won't be on there.
And a lump sum election occurs on the 15 return.
On the 15 return. But it's not going to save you any money. It's still going to be at 85%. But
I'm not concerned about paying the taxes on it. I was concerned with reporting on the FAFSA.
I mean, there are times when you cannot have your cake and eat it too, and this is
one
of those times, you know.
Okay.
All right, Linda. I'm sorry. I'm happy but sad for you. You know what I mean?
Yes, thank you.
All right, thank you, dear. Bye-bye.
Bye-bye.
Yeah, I mean, it's so sad, because she's got a blessing on the left-hand side. On the right-hand side, it's a problem. But the good thing is next year that won't be there.
That's right.
Because one thing about going to college, it's an annual trek down the FAFSA thing.
My gosh, next year my 10th grader who's going to be an 11th grader has to do her FAFSA form?
Yep.
Yep.
So I want to talk about other things you should watch out for. Not filing your taxes because you have income that's under the threshold level to file, even though you have a refund coming or earned income credit. Let me put that in layman's language. Let's say you made $6,000 and you say, do I have to file a tax return? I got a part-time job and I make $6,000, and maybe you're 28 years old. And so under the law, you don't have to file. However, you have an earned income credit coming, and if you don't file, they're not going to give you the money.
Right. I have a perfect example. Today I was with a client, and her husband lost her job, and she makes $12,000 a year. They have a student who's a junior in college, and they qualified for the earned income credit this year. They didn't have to file. The numbers were low enough that they didn't have to file. They were under that threshold that you talked about, but they got this big, huge earned income credit.
Right. And if you don't file the return, you lose this money.
Right.
And in some cases, we're talking $8,000, $9,000, $10,000, $12,000 in refunds from the earned income credit just because you have the right circumstances. If you have children living in your home, or if you're between the ages of 25 and 65 and you have income like under $18,000, $20,000, married filing a joint return from wages, you could get an earned income creded. It's not as much, obviously, if you have children. If you have children, it's like a really lot of money. I'm Esther Gulias, the tax lady, 803-0930, 803-0930, star 930 on a cell phone, and we're going to go back to the phones and talk to Ed. Hey, Ed, Mr. Ed, how can we help you?
Yeah, Esther, I have a question about Form 1095.
Uh-huh.
Does everybody get that form?
You mean the 1095 A, B, or C? That is the health insurance form. You don't get it if you didn't pay it. If you didn't have health insurance, you don't get a 1095 form.
But what have you had? You've.
In other words, Ed, when you were working, you got a W-2. When you have health insurance, you get a 1095.
Okay, but if you're retired.
Okay, and when you're retired, you have Medicare. On your Medicare, it shows that you have Medicare Part B. That the IRS already knows that, so you won't be getting a 1095 form for that.
Okay, could you say that again, just on Medicare?
If you're on Medicare and you're over the age of 65, you're on Medicare, you won't be getting a 1095 because the government already knows you're covered by health insurance.
All right, you've answered my concern here. Thanks a lot.
Thanks, Ed. Bye-bye. This really, the whole 1095 thing is really interesting.
Confusing.
Because there's a B, and a C, and depending upon if you work for a public employer or a municipality, or whether you are a private payer yourself and you use the health, New York State of Health, or any marketplace, or whether you have a regular employer and they're paying your health insurance, you get a 1095 A, B, or C.
Right.
And the reconciliation, if you have partial health insurance, you didn't have it for the full year, or maybe you got a subsidy, this has to all be fleshed out on your tax return.
That's right.
But not if you have Medicare, because if you have Medicare for the whole year, you're in good shape. But if you didn't get Medicare because you were under the age of 65, you're going to have a 1095A form.
Yep, and so I think you answered his question.
All right, let's go to the phones, and I got Diane. Hi, Diane. How can we help you?
Yes, let me just follow up for that other gentleman. That 1095, do you have to attach that to your income tax, or is that for your own records?
Just for your own records.
Okay, my question is regarding FATCA. I'm a U.S. citizen who lives in Canada.
Okay.
And my Canadian bank has sent me a W-9 to complete.
Uh-huh.
They want me to put my name and Social Security number and sign it.
Uh-huh.
But it's a joint account.
Mm-hmm.
And my husband's name is first on the account, and he claims the interest in Canada for that joint account.
Mm-hmm.
So I'm thinking that if I put my name on it and my Social Security number, they're going to be wondering why I haven't been paying tax on it. I do file the FBAR. I do report that I have the account, and I report the, the 8938?
Mm-hmm.
And I indicate that it's zero in terms of any interest I reported. But I'm just wondering.
Okay, so here's the thing.
Okay.
So in your situation, you're a U.S. citizen with income in Canada. Is that correct?
Yes.
All right. So you have assets in Canada over $10,000.
Yes, and I live here, right.
Right.
Mhm.
So you have to, basically what's happening is you can see that the federal government is trying to track people who have money outside of the United States who are U.S. citizens. So you have to do all those forms, the FBAR and all those other forms, and just report it. But if your husband has it on his Canadian return, and you do not have, and remember, as a U.S. citizen, you have to pay taxes on worldwide income. So if half of the account is yours, you may have to file a tax return, depending upon how much it is, in the United States. But probably you won't, because I'm assuming the interest isn't more than like $12,000, is it?
Well, there's different accounts. I'm going to say no, it's under 12,000, but I do file because I receive New York State pension, Social Security.
Oh, okay.
etc.
So you are doing a U.S. return.
Right, but we file separately.
All right, that's fine, because you have to be taxed on worldwide income. But if half of the account is yours, then half of the interest would be yours.
Well, the account is 100% his.
Oh, well, I thought you said your name was on it.
It is on it, but it's his money. And now in Canada, when you file, you determine whose money is in the account, if it's 50-50 or 30-70.
So as long as you guys can prove that in the event of an audit that the income belongs to your husband, then there shouldn't be a problem.
Well, on the W-9, do I also list his name, though?
No. No, they're only interested in you because you're a U.S. citizen.
Right. I know when I've inquired at a U.S. bank where I have an account, they told me that W-9 would only be given to the person to sign whose name was first on the account.
Okay, but I believe that what you're looking at now is that this is a tracking mechanism, and it isn't anything. I mean, I guess to be frank, why is it you just take your name? Why don't you take your name off the account?
Well, I mentioned that, and to an accountant actually, and also to someone at the Canadian tax office, and they says, "Oh, don't do that." The only reason it's on there is because in the U.S. you can have an account in the husband's name in trust for the wife.
Right.
They don't do that here.
Well, again, this is a tracking mechanism that's being instituted by the federal government, and I would have, if you know you're right, then I'd have no compulsion doing it. So that's your decision.
But would they, as you said,
I can't say what they're going to do. I don't know, Diane.
That was our first.
But
thought.
I mean, I think that you have nothing to hide, so I don't understand the problem with it.
Okay, as long as I can prove that it's his money.
I mean, right, and that's the bottom line, is they just want to make sure that Diane is not concealing money.
Mm-hmm. Yeah. Well, we thought
Big Brother is watching,
We thought we were doing something very simple because my pensions and things go into a bank account in the U.S. and I claim all that interest.
Right.
His pensions and things go into the account here and he claims that.
Yes, sometimes, we can overthink things, so.
Yep.
Okay.
All right, thanks,
dear. Bye-bye.
I was reading while you were talking to her. It says online, FATCA was estimated by the United States Joint Committee on Taxation to produce approximately $8.7 billion in addition tax revenue over 11 years.
Right. Well, that's because a lot of people don't know.
Right.
As a matter of fact, I had a Canadian that came in today, and he's living in the United States, and he's got a Canadian pension, and he wanted to file a joint return with his wife here.
Right.
And I said, I need your Canadian pension. And he said, why? It's from Canada. And I said, because you are now a resident of the United States and you have to be taxed on worldwide income.
Right.
So he said, wow, I didn't know that. So I downloaded the thing from the Internal Revenue to let him know. Okay. I'm Esther Gilius, the tax lady from EG Tax, 8030930. 8030930, star 930 on a cell phone, and want to talk about other things people do that they should watch out for. Like Tiffany said, not keeping track of your stock basis.
Right.
When you have reinvested dividends, really important.
But I know since 2012, the IRS enacted that the brokerage houses have to.
Right. But prior to that, and you got to, it's not a bad thing to watch your broker.
That's what I was
not
thinking.
Taking the American Opportunity Tax Credit when your child is in college because the kids took out the student loans. That's it's a big problem because the parents actually can do it, even though the loans are in the kid's name.
Right.
And it's like $3,000 the parents overpay by. Not taking the college credit on the New York return.
Right.
Not claiming the daycare credit on the federal because you don't need it, because you don't have any tax liability, because on New York State it's a refundable credit. So you want to
Absolutely.
make sure that you do that, or you're going to overpay your taxes. All right, we're going to go to the phones and talk to Doris. Hey, Doris, how can we help you?
Hi, Esther. When I was in to see you last year for my taxes and I said I was looking to buy a home, you told me to make sure I bring in the HUD form for the next year.
Right.
So the only HUD form that I have in my closing cost paperwork is the good faith estimate, the GFE. Is that what you're talking about?
No, it's a HUD-1 form. And so
stands for Housing and Urban Development.
And where am I supposed to find it?
Your attorney who closed it for you
Oh.
will give you. It's a big long sheet of paper, double-sided,
columns.
and 2 columns, and it has all kinds of information. The estimated expenses are not actual expenses, so that closing document, you can either bring in a closing document or the HUD-1 form.
What do you mean by closing document?
That would be the thing with all the numbers that said you're buying the house for $200,000. The taxes are reimbursed at so much per day.
Okay.
And the down payment is so much, and the search and survey and the title insurance is all on there. It's what your attorney would have given you to say how much money you needed to bring to closing.
And they can
that
get
I
you another
have.
copy.
But
Okay.
the HUD one, they don't give that to you. You have to request it.
Well, it should be in your packet, but if they didn't, you should call your attorney and ask where it is.
Okay.
And don't forget to bring your 1098 if you have a mortgage on the house, Doris.
1098.
That would be if you have a mortgage.
Yes, I do have a mortgage. Now, this is a form that would be with my
From the
closing
bank.
also?
The bank's going to send you that with your mortgage, interest, and property taxes.
Okay.
And
they're
if you
escrowed.
did anything energy efficient, don't forget to tell Esther new windows, new
Right.
front door, garage door, hot water tank, if it's energy efficient.
Okay.
Tankless.
All right.
Energy Star.
Thank
Okay?
you very much, Esther.
Thanks, Doris.
Bye-bye.
Bye-bye. I'm Esther Galias, the tax lady from EG Tax. If during the week you're stumped and you need tax help, go online to egtax.com. It says Ask a Tax Question. That'll come right to me, and I will answer you, even if it's in the middle of the night. And for those of you that have tried me, you see I answer in the middle of the night. Because my phone goes bring, and I will get up and answer it. So, because I'm a very light sleeper. But until next week, I'm Esther Galias, the tax lady, with Tiffany Fabian. We hope to be able to serve you. Have a great week. I understand it's supposed to be warm. Talk to you later. Bye-bye.